We move now to our first panel session, which is on funding. What have entrepreneurs experienced when raising funds? How have the processes worked? What might they do differently, knowing now what they do? Please do send some questions in, anonymous or named as you like, as we bring forward our funding panel featuring 3 entrepreneurs and an advisor. We'll be seeing Roger Saul, founder of the iconic Mulberry, which floated and then exited. Charlton House Hotel he founded, Kill the Court Retail and Sharpham Park, now focusing very much on spelt. He is almost the very definition, and forgive the pun, of a serial entrepreneur. Okay, you won't forgive that pun. Next up will be Claire Ladkin, founder of All About the Cooks, also the chair of Bristol Food Connections, has recently raised somewhere north of £300,000 via crowdfunding route through Crowdcube. Here they all are, aiming to launch in 6 cities. Nick Hounsfield, quite an extraordinary blue health entrepreneur with The Wave. We had the great pleasure of interviewing as part of Bristol Life Business Club a couple of weeks back. First inland surfing location, launched in Bristol with London and others to follow, raised the best part of 30 million to make that vision a reality. And then Richard Spilsbury, Linkstone Advisory, one of our associates, PwC background, and then Future, Play Sports Network, now a portfolio non-exec and advisor. Richard, I'll bring you in a sec when we've heard from our entrepreneurs. Let's start with you, Claire, if I may. Hello. Good morning to you all, by the way. Good morning, panel.
Good morning.
Morning.
You were there.
Morning.
You were there briefly, and you're back again, back in the room, as they say. So, Claire, let's talk with you. Tell us about Crowdcube, why you chose that route, how it worked for you. Any observations?
Yes, of course. It's probably worth starting off saying what our business is, because that's part of the decision-making process. All About the Cooks is an online marketplace to buy and sell home-cooked food. And because we are very much about our cook community and about working within communities in a hyper-local way, but on a grand scale, it made sense for us to use and to choose an option that was about community. So by using Crowdcube, we've ended up with over 200 investors and people who are sort of buying into our mission, if you like. And that's been quite an important process. That doesn't mean to say that I didn't try other routes. I think there's something that's quite significant about the fact that once you're out of the very high tax break for investors, it sort of falls off a cliff for a bit. I didn't have the valuation to to support a raise of £1 million plus. So I needed to raise about 300,000 or 400,000 to get us to the next step for the business. And that proved to be quite a difficult thing to do. So I did explore other avenues and found it was really, really hard work. I needed to have enough money to make a difference to our prospects, and crowdfunding proved a really good way to do that. It was efficient, but quite hard work. It still is quite hard work as we tie up the loose ends, but it is brilliant now to feel that we've raised £330,000 and we can start planning for the future instead of worrying about burn and have a year of respite from raising perhaps.
And I guess through going this route, your funders are also potentially customers, very definitely, but also advocates for you in a way that perhaps other investors may not be. We'll come back to do the compare and contrast in a moment. Roger, as that serial entrepreneur, I'm still trying to shoehorn that pun in. Anyway, you've been through a variety of funding routes. Talk us through your approach this time. I think you were intending on going through a crowdfunding route, and there's been some recent developments in that area.
Yeah, so we probably a stage on from Claire. So Sharpham Park, our food business, we're a sort of 1.5–2 million turnover business. We have just launched a new spelt drink range, which from my point of view meant this is a massive opportunity and I really need to try and grasp it and blast forward. So we put together a business plan accordingly. And we've set out to look for around about 2 million. We set out early, we had an investor there on that scale, they dropped out at the very last minute. So that suddenly left us, having spent 9 months on that route, going, oh, what should we do next? So we then turned to look at crowdfunding, thinking, okay, well, we could do with 500,000 to get us going. We've looked at that. We've held off going into that route quite yet. And I suppose we're balanced at this moment. I look forward to hearing what other people say. We're now in talks with some other big investors. And so I'm juxtapositioned at the minute, if that's the right word, to say, shall I go for the big one and hold off and do seeders at the end? Because as you said, Greg, I really like the idea of engaging. We have about 30,000 followers on our website, and I'd love to engage those customers and bring them in. So I think we will go for the bigger investment side. We will probably do that over the next 3 months. And then I think we're tying up with seeders. We're all ready to go. We could go tomorrow, but I think we'll do that as a second step.
So you're not quite putting it in these terms, but seeders, in a sense, or the crowdfunding route, it's a fallback, but yes, it does have those other benefits as well. But meantime, unspoken as who it may be, but other investors are, if not beating a path to your door, you're in negotiation with or discussion with, which sounds really promising.
Exactly.
Really promising indeed. Okay, and just back to your previous incarnations, as it were, floating Mulberry. What was that experience like, and the relationship there with your funding source, essentially?
Yeah, so I think like many companies, we went through the 70s, the 80s, got to the 90s, and like so many businesses, we were growing like a rocket. We were just not able to cash flow a very profitable business moving forward. We then hit the Gulf War recession, and we could see that if we wanted to do the American market in our new Mulberry home business, we would need to bring in funds. Now, I'd already bought in a 5%er, a direct investor, and I could see that the next stage, we really would need to bring in substantial funds. So I think we bought in at that stage, perhaps 5 million into the business. And we did that through venture capital. We bought in Charterhouse, Phoenix, and Kleinwort Benson. They were absolutely superb, really good set of investors led by Charterhouse. And the one thing we hadn't realized going in the early 90s, a little bit naively, we were doing what was called deeply discounted loan notes, which rolled up, which meant we didn't pay any interest, but interest was at 30% per annum. And that raced through the early 90s. So by the time we were highly profitable and got to about 95, 96, we could see that this was all going to have to come home at some point very soon. And the VCs were looking at their 5-year point saying, well, what are you going to do? And at that moment, the AIM stock market appeared. And our advisors said, look, you should really have a go at that. You would be a cracking possibility for this new market. So we went on AIM, and we got a wonderful Times headline saying Saul brings color to the market, or something like that. And we went out at exactly what we set out to do. I think we were 3 times oversubscribed. We took out the venture capitalists. They got their money back times whatever, and were very happy bunnies. However, we didn't bring any more money into the company. And I think that was a big mistake, because a year later, Gordon Brown gave control of sterling to the Bank of England. Interest rates rocketed up, the pound went super strong, and we were an 80% exporter selling in local currency. So suddenly we went from making a lot of money. Well, I think we went from making 2 million to losing 1 million in a year just on currency. Big lesson for everybody to remember that. And so we then had to seek external investors, and we brought in a lady called Christina Ong from Singapore, because we could see we wanted to develop the Far East market and the American market, where she had a very strong position. So we did that. That was probably personally the biggest mistake I ever made, because she set out to remove me from the business, even though I had a bigger shareholding. And this is just worth remembering. I think I had 45, she had 42. But one of my co-directors jumped ship to the other side. And so suddenly I was a statistic, but I still owned 43% of the business. So I think the lessons in all of these things, as you get bigger, as you scale, as you're looking at it, I think whenever you bring funds in, from my perspective, you have to understand that you are captain of the ship, you are driving it forward, you have an investment in it, but it is now owned by a number of people. You are there to guide it, but it isn't yours. It's now everybody's. And I think that's a vital lesson, accepting that you're on a journey which can be very exciting. You've now got to talk to a wider audience, ever wider audience. And as long as you're doing a good job, they'll be very happy. But if something goes wrong, and I think a classic there was that one I've just described, Those were way beyond my control, those circumstances. I couldn't have believed they could happen. Just like many of the things happening today, we couldn't believe would have happened. So I think you have to be aware of that and accept that that's a fact as you go into any funding round on any scale.
There's some good warnings there. Some is the happenstance, the external circumstances you talked about the currency conditions, beyond control, but less mitigatable, I guess. But the other is this psychological realization for an entrepreneur that whenever there's a form of investment in whichever structure, the change of control, responsibility, the requirements of funders and investors actually means you have to run a business differently. It's no longer quite yours in the same way. Let's bring in Nick at this point. Yours was a bigger scale investment at that point. You'd started, you're previously a chiropractor. You'd started this business with allegedly £500. Seems like a very small basis for a business. But talk us through the process to raise nearly £30 million and over such a long period.
Yeah, and in fact, we've just finished off doing a funding round, which will open up 200 million. But fundamentally, it's the same process going through. And I guess it was step by step. I've never raised any funds apart from trying to get some pocket money out of my dad, I think. And so it was all new to me. And fundamentally, I guess the basis for me, particularly with what we've done with the Wave, is about initially having a really, really clear sense of purpose, why we want to do something, what we're wanting, the impact that we're wanting to achieve in the world, and being able to talk about that compelling vision very clearly. And because I definitely noticed that along the way, we've probably done about 230, 240 meetings with investors. And fundamentally, yes, whilst obviously the economics have to be right and be investable, there's still a huge amount of the gut decision around wanting to go with us. And the whole, from having just 500 quid right the way through to the funding round we've just finished, fundamentally it goes back to the purpose, having funders on board who believe in the same things that we believe as a company, right down to the people that clean the toilets or scrub the lake or whatever it might be. There's a real, across the whole board, all of our shareholders, right down through everybody in the company, we've got a very clear mission and values really aligned in that. Now, to get to where we've got is also about de-risking, particularly in the early stage where we had a completely new industry with new technology that hadn't been proven. I personally had absolutely no experience, was completely naive through the whole of the last sort of 10, 11 years. And that's about getting a good team around you who are much better than anything that I could achieve, a really clear vision, and de-risk as much as possible through that whole process, to make sure that we're an investable business. And I think it doesn't matter from right down at the first stage where had to raise 150,000 to get through planning, right the way up to what we've achieved just in the last month. I think it's the same process. It's just obviously scales up.
You've talked before about not being, I'm trying to put it in the most straightforward way, not being the most financially focused, or at least most numbers focused as an entrepreneur. What advice, and I don't mean that at all rudely, I think entrepreneurs are brilliant at doing what they do. What advice would you give for other entrepreneurs who don't necessarily have that financial focus? Roger talked, for example, about the complexity of the debt funding that he had in his business at Mulberry earlier days. What advice would you give about how to navigate that process with people who are much more financially savvy than you will be as an entrepreneur?
Well, 100% is about getting an amazing team around you, people that you trust, and it comes back to trust. Can you trust the people around you, or build build a team around you that you trust, that you their advice that they're giving is good advice. Obviously, you can go to external advisors as well to be able to work with them. You know, we've got lawyers and corporate finance team who help me, and I trust them without a doubt. So, you know, that's a big basis around that. But still, it comes back to, I believe, having a compelling reason that it was interesting, this recent round that we've gone through, which is it was a massive round. But fundamentally, there was a moment when we were doing the deal where all of the finances all worked out and all the rest of it. But there was still a moment where everyone around the room said to me, "Are you happy? I feel like you're a little bit peeved with us." And actually was able to open up this conversation around trust. It's like I feel like I'm handing over this amazing thing that we've built over the last 10 years, and I'm looking at you. Can I trust you? And what was great is that they, you know, then had to come back to me straight away and present a compelling reason why we would take them on as investors, although we absolutely needed them. There was still this quid pro quo about, actually, can I trust you going forwards?
I think that area is fascinating, in particular, that sense of trust, because it's, you know, many entrepreneurs will approach this as, I need the money, as opposed to, can I trust these people? Are they going to be supportive? Do they get the vision? Will they back at the point at which you have to make whatever the radical pivot may be? All businesses have to make change. As Phil talked earlier, most businesses don't hit their initial projections, of course. Can you trust your investors? You also talked about the value of advisors. Let's bring in Richard at this point from Linkstone Advisory. Richard, good morning to you.
Good morning.
There you are, sir. Very well. Can you give us some, I'm going to put you through a starter kit here, if I may, some quick definitions to help us, please. The differences in structural approach between, say, crowdfunding, angel investors, Series A, B, C rounds, whatever, VCs, private equity. Go. Tell us, as you know, imagine you've got an audience which doesn't really fully get the different types of funding routes.
So I think there are different funding routes, and I think the trick is to try and find the funding route that's right for you. So when talking about crowdfunding, then very often that's a route that's most available to consumer-facing businesses, because consumers get it and they get incited by it, and to some extent it can work that they think they might get some benefit from it as well. They might get the product or the services at cost, or they might be able to engage in it in some way. So that can be a quite attractive route. And very often crowdfunding doesn't come with a lot of interventions from the investor. And so that's why it's attractive. However, it's quite a fickle market, so it will depend on the sector. So for example, if you're a brewery, then breweries did a lot of crowdfunding in the past and they kind of burnt their bridges slightly. So crowdfunding is something that's best suited for consumer businesses as a whole. There are other sources available. So, for example, asset-backed financing. So, Nick, I presume your business seems to have quite a lot of assets, and so I presume a lot of your financing is because you're able to put your assets behind that loan. And so that's another really good route as well. Now, what is an asset? It might be a physical thing, or it might be the stock that you own, or it might be the money that you're owed, or it might in technology be your recurring revenues. So that's another route of raising funds. Then you've got angel investors. Angel investors tend to be they're high net worth individuals who want to make an investment, and that might be for there are some various tax advantages to help them, and also that that they might want to sort of just increase their total sum. Now, very often finding those angels is difficult. There are some regional groups. So, for example, in Bath, Bristol area, we've got BPEC, Business Private Equity Club, very active. In Dorset, there's another group, and other regions have their own groups. You can also use databases to identify where who are active investors, something like Bowhurst, where you can see who is actively investing in a different sector. And sometimes those are people who have made money in that area before, or they've worked in that sector. Then the other areas that you mentioned, Greg, are sort of Series A, B, C. Though these tend to be for more mature businesses, and they will be venture capitalists typically. They'll be looking for quite a significant return, and they'll want a business that's quite mature. It's earning profits, and it's established that it can grow, but it doesn't have the resources to do that. So they will look to invest to accelerate. And the ABC just reflects the different stage. So A is the earliest stage, and then B is probably bringing on some additional VC to scale, maybe in the US. And then C might be where some of the earlier investors are looking to get out, and you've got a bigger player coming in. I hope that makes sense.
Helpful indeed. Let's bring our panel back, and I want to ask a question to you each. Having been through the approach as you've described this time, what would you do differently if there is a next time? In other words, essentially, what has been part of your learning process? Don't all rush. But one would be
from my perspective, it would be, I think, for everybody to realize that these things don't take a few seconds. You could be in it for a year. You know, when you first envisage, I'm going to go and find funds to grow my business, I can see my business is at a moment in time where I've got a really good possibility to accelerate. I haven't got the funds. You go back to Richard's point, what funds will I need? Which way will I go? So many people won't know Richard's variety of different offers. So you'll need advice to get into the picture, as we're just talking about. By the time you've got yourself sized up, you probably spent 3 to 6 months doing that and sort of seeing, well, how much do I really need? You've got to put together a business plan, and you've got to put together a deck and a teaser and all the information that anybody who's investing wants to hear. So you need advice on that scale. So there's a lot of advice to seek. There's a lot of information to gather. And I think you've got to allow yourself 6 months to really put that all together to go out. At a minimum, probably, successfully to third parties. Doesn't mean to say you can't sort of go out half ready and start those discussions and start moving and talking to people, because by talking to people, you're going to feel, how viable am I? You know, have I got a business here that will excite people and take them forward? Where am I in my business growth cycle? What's happening to me and my competitors? I think understanding the market around you, really knowing where you sit. Are you as exciting as you think you are, or are you not? What's going to happen next in the marketplace? And I think for all of us, I wish I could tell you what was going to happen in the next 6 months. And I think any one of us would sit here and go, this is a difficult one. You could say it's going to fall off a cliff in September. I don't think it will, but I think there are going to be some real struggles. In our world, we've all seen the Ukrainian wheat, Russian scenario, which is just horrendous. That's going to be horrendous for the worldwide. However, what we haven't perhaps quite realized is that relates so far to feed wheat for animals. And that's why you've seen chicken, beef, etc. accelerate. You haven't seen the beginning of it yet for bread and everything else, because millers all buy their grain for a year and they won't hit that problem till now for the next 3 months. So food price is going to go on yet again. I wouldn't surprise me to see 15%. So what does that mean for me? Well, I happen to have bought 2 years of spelt. So I'm looking pretty good at the moment, but I know when I go to my farmers to grow next year, apart from myself, I'm probably going to have to pay a 30 or 40% premium over wheat to grow it in the next year. So that would mean in 3 years' time, I'm going to hit some major price increases. So all of these things, I'm sorry to give you my examples, but all of these things you've got to sit in around you and say, where do I sit there? But it mustn't stop you, and I'm sure Nick would be the first to say this, mustn't stop you striding forward and really going for the target you're going for, but you just got to take them into account and really balance them out.
You're exactly right with Nick, and indeed with yourself and many other entrepreneurs. Nothing does stop you. That's the resilience and relentlessness that Phil was talking about. But I'd like to come to both Nick and Claire about, in that interregnum, some months, in Nick's case, some years, where the financing wasn't in place, Was the business essentially on hold? I mean, how did you navigate that time, which inevitably was probably longer than you expected it to be? Nick, perhaps you first.
Wow. I guess having run a lot of the process, probably nearly 5 or 6 years, pretty much by myself, but with some trusted colleagues around me, but striving forwards. I was the only person for probably four to 5 years of I was full time on the Wave. I kind of none of that time was wasted time. I think there's a real timing issue around. Yes, it took me 10 years to build, but if say for instance, if I had 30 million pounds in my back pocket, I wish right back at the beginning, I would have made some of the most ridiculous decisions of my life, and therefore I think we would have failed. In fact, I know we would have failed. We would have taken the wrong technology. All sorts of things would have failed. So for me, it's a little bit, yes, it took a long time, but actually there's serendipity in that timing. For me, the right time was to take 10 years. I might have been able to shorten that maybe by a year in the whole round, but actually I feel like, call it fate, call it being market ready, whatever it is, it needed to take 10 years for us to become the business that we could become. So in that time, yes, there were sort of definitely lulls, and it's not mothballing anything. There are lulls. So then I go, right, I've got 6 weeks, for instance, where I can't do anything, like everything's out of my control. So what can I do for these next 6 weeks that will actually inform me, so that when those 6 week wait is over, I'm in a better position as a business, as a person, as a team, to go again, once that threshold's been over.
So expect the time to be longer, but use that time for benefit. To your phrase, how can I become a better person? I mean, that's quite an extraordinary thing to say, but there is that contemplation time. And as Roger's talked about, the iteration of going out there and talking about your business, you do learn, test, go, I guess, during it. Claire, I'd like to bring you in on the process of how you ran the business during that time, but also to pick up this question from Christoph Sturton of Catalysm. He'd asked, what issues are there around keeping your idea safe when crowdfunding, and how can you protect yourself? So talk about the time, but also about that protection point.
Yeah, so we launched the business about 18 months ago. We took some SEIS investment. That was one of the things I need, talking about testing and going. I needed to test, do people want to buy food, do they want to sell, and is it attractive to objective investors? We had quite an intense 9 months period where we focused very much on sales to test those things and find out more about what our users and our cooks wanted. And we felt then that we had proof of concept. So this has been quite strategically plotted. So that was where we were at. We've got proof of concept that people like this. There's a prospect for a feasible and growing business. It only makes sense at scale. So I then had to take that proof of concept and get investment behind it. And yes, it took longer. And yes, it was a bit hand to mouth. And we're a very small team. So that was a struggle because we just only had so many hours in the day and so much energy and motivation as well. It's disheartening when you keep going up dead ends. But no, we stuck with it and it's been brilliant. So turning point was around Christmas, but then it's taken us until now to actually bring that crowdfund into fruition. So it's only now that we're getting the money from it.
And to pick up that point from Christoph about the issues about keeping your ideas safe and protecting yourself.
Yes, and it is a challenge. And I think for us, there's something about first mover advantage. There's a lot about branding as well and leading from the front. But it is. There's no point in being the best kept secret in town. Nobody's going to know about you. Nobody's going to use your product. So you just have to embrace that and go with it. Actually, I can't not tell people about my business if I want them to use it. So we're out there. Yes.
And if only there were a conference which put together a whole load of entrepreneurs and investors and advisors, perhaps called EntreConf, you could use as a platform to talk about what you do, purely for example. Let's bring in Richard at this point. We're coming towards the end of the session. Just some closing thoughts from you about practical advice for entrepreneurs and how to marshal their case for funding.
Okay, so the work that I see, I think there are some key. I'll touch on some of the key barriers for raising funds. The first one I think is be sector specific, and there are some really specific issues for different sectors. So, and you can get advice on that from peers. Secondly, is the minimum viable product not being ready. Thirdly, is not having any market validation, any kind of real proof that people want your product. Fourth is an unclear competitive advantage, which ties in with Roger's points about understanding the market context. Then lack of routes to market. Sticking an advert on Facebook probably isn't enough for an investor. Not having a plan to scale, unrealistic finances, and then not having a good advisory team around you. You're not expected to know everything, but you are expected to be able to build a team of people who can support you as and when needed.
Thank you. One last question for our panel, and as I say, we are coming towards the end of this session. So it's this. In brief, as well as keep going, what might you have done had you not been successful in this funding round? What were your alternatives? Just keep on keeping on? Is that the message?
Yeah, stick to plan A.
I'm going to push on that one, Nick. Stick to plan A and don't have a plan B. Is that? I mean, I'm putting words in your mouth, but
yeah, I mean that's my perspective. I know some other people in my team will always have a plan B, and that's for them to chew over. But for me, it's about a plan A. I don't like putting effort into a plan B because you're not focusing on plan A.
That's your particular single-mindedness, which is a key characteristic of many successful entrepreneurs. Roger, Claire, stick with plan A, push on.
Yeah, I would definitely. You've just got to hunker down and steam on with what you do best. But unlike Nick, I would keep looking for every plan B, C, D, E, F, G, because I still want to go forward. But I know that Nick's absolutely right. You've just got to do what you're doing really well and make sure that you're staying in there. So you become a submarine, periscope's up, but you're underwater, and you just got to run underwater for a while, and you will be able to come up for air at some point.
Remember, you'll be able to come up for air. Claire, you've come up for air. You're about to be fully fledged as a funded business and get going. Did you have a plan B?
No, we don't have a plan B, but we are constantly looking to mitigate, and we've talked a bit about de-risking, and so that's very much on our minds. You know, we're trying to make sure that we've got good fallback, if you like, if things take longer or don't go as well as we thought. But I think there's something really core to sticking to your values and everything, the reasons why you started this in the first place. For me, I wanted to leverage the commercial imperative of investment to make a massive social impact. And even if that we have to compromise that a little bit, I don't anticipate that we will, but then that will remain our core value and our core purpose.
Well, thank you to our panel. You know, it's a complex area. We're not going to cover every single eventuality. We'll be hearing later, for example, from Tumalo about how they raised their $90 million. Levi Roots, how £50,000 transformed his business via the Dragon's Den, different routes to markets. I've taken a few, I think, key points that our panel have been talking about this morning. One is the practical, the time it takes. Two, the different routes to funding, as Richard talked from Linkstone Advisory. Three, the value of strategic investors, whether that is those who understand the sector or at a more consumer level, those who become advocates, perhaps through the crowdfunding route. Also, the psychology of funding and what it does to your sense of ownership and your responsibility to your investors. The value of advisors, always. And also that point which has come through very, very clearly in just this last element, which is stick to your values. That's what people are going to be investing in, and it's not about reshaping it for someone else's wish. Your values, your vision, your greatness is what they will be funding. To all of our panel, I'd just like to say thank you on our behalf to Roger Saul, Claire Ladkin, Nick Hounsfield, and Richard Spilsbury of Linkstone Advisory. To you all, thank you very much indeed. Thank you.
Thank you.
Thank you.
Bye.
Thanks.